I don't know that I actually put them into that pipeline, right? And if I'm tracking out if you're doing it out of there, then I have to create a new. It doesn't mean the project has to do anything, but we have to be the ability to drop a new project in.
Hello.
Right now.
Hello.
Who's there?
Jesse Keenan here.
Hi, Jesse. Go ahead and share your screen, and Sasha and I will do some quick intros for everybody on the call. While you're getting those.
I think I have it shared now. Let me know if you see it.
I do not see it right now.
Okay. Let's see, share screen.
Well,
Can you see that?
Yes.
Right, no, we're not tracking, which is exactly right.
It sounds like somebody is not on mute, and so if you could at this time just, everybody please make sure if you're not the speaker to put yourself on.
Might need to less.
Thanks. Alrighty, so let's go ahead and do just a brief introduction. Sasha, if you wouldn't mind, I was thinking you could just very briefly introduce the network and some of our previous work together, and then I can go ahead and introduce Jesse, our first speaker. Does that sound okay?
Yeah, sure. Thanks, Sam. And welcome everyone to this afternoon's webinar. Our Climate Migration series continues. This will be the last of the year. The Climate Migration Network, or what used to be called the Coastal Transformation Network, began almost 2 years ago now with a convening by the Consensus Building Institute in Boston to consider the issues of coastal retreat and why this as one of the key options for coastal resilience is not being fully considered in the public dialogue. And so the motivation for this webinar series and series of other convenings is to explore that topic and move the issue forward. As part of our network, we have people from many different sectors, from the conservation and coastal resilience side, from cities and urban planning, philanthropy, community groups, equity and justice groups, all trying to consider this in tandem. I'm sure I'm leaving out other interest areas as well. This webinar and the prior one explored important finance questions about how to tackle the bedrock question of how to pay for coastal retreat and increased resilience measures. And today we've got two really exciting speakers that are going to take the wraps off really two quite new ideas or adaptations of old ideas, but new versions of them that we think have potential for unlocking coastal retreat and coastal restoration. Sam, do you want me to go further and introduce our speakers, or is that your job?
I will go ahead and introduce the speakers. So we've roughly divided the time in half today. Our first speaker is Jesse Keenan, who is a member of the faculty of the Graduate School of Design at Harvard University, where he serves as area head and director of real estate and the built environment. Jesse's principal research focus is on climate change and the built environment, including aspects of design, engineering, and financing. So Jesse will be presenting about his recent white paper and publication on regional resilience trust funds. I think if you could just hold all questions to the end, there's a chat icon at the bottom of your screen if you're on a computer. Go ahead and open that up. And if you just send a message to everyone with your questions as they're kind of occurring to you, we'll try to get to those at the end. And our speaker for the second half is Shannon. Cunniff, I believe I'm pronouncing that correctly, but Shannon, you'll have to correct me if not, who's the Director of Coastal Resilience for the Environmental Defense Fund. And we'll say a little bit more about her and her work later. But Jesse has his slides queued up. Alrighty, Jesse, and I'll turn it over to you here.
Great. I hope everybody can see the slides, and I'll be brief in a way because yeah, it would be I think beneficial by some measure to have some discussion around this. Also, it is a pleasure to join again with Shannon Cunniff, who I believe we also have done these presentations back to back now for the second time in a different forum. So a type of sharing and learning there that I very much value. Let's see if I can have the ability to move my slides. So this is based on work that was sponsored by the Regional Plan Association as part of the 4th Regional Plan. Rob Freudenberg, who's Executive Vice President for Environment and I believe Energy Policy at the RPA, was very keen on thinking about a wide range of potential financial mechanisms, instruments, and as well as the economic consequences associated with climate change, particular inundation from sea level rise in the New York metropolitan region. This recently came out, it was published as a formal paper within the RPA, but also a peer-reviewed version of this was just released in the journal Environmental Systems and Decisions, for those of you who are more or less ambitious in looking at the underlying methodology. When you look at the world of adaptation finance, it comes in one of two prongs. There's one which I think those of you who work in the international community would recognize, relating to, let's say, the international development and those funds that were put together by sovereign nations coming out of particularly COP21. And it's really about a sort of compensatory offset of in the advancement of intellectual property and other things that help developing countries more or less adapt to a changing economy, environment, and so forth. Then there's a whole other world of financing, and mostly from a sort of grant and limited sort of debt positions in the world of conservation biology and in wildlife management, I should say. And so it was really limited, I would say, portfolio experience. So one of the things we wanted to do is think about this within the mechanisms of an urban economy, within a tax base, within tax rolls, within a variety of different mechanisms that are driving not just the finance part, because as it turns out, and I think many of you will have or have had this conversation in the course of particularly coastal adaptation, it's not so much about finance, because my finance part of it is fairly straightforward in a way. It's really about governance, and it's more fundamentally about revenue streams that support the finance. And so in a way, one of the first things we did was to think about, well, what is the appropriate type of governance model? So let's say we'll just leave aside where the revenue and the money comes from. Let's just say that we independently develop a stream of funds. How would we manage that? What is the most appropriate way? How do we engage people? How do we engage people not just for the political base, but also for a type of vulnerability assessment, as well as a determination of what is the weighting of what should be prioritized? That is, among competing projects for the limited amount of capital, how do we have some determination as to how we not only prioritize A from B, but also how we think about the financial underwriting relating to the sustainability and independence of any given portfolio. And what we came up with in partnership with here at the Graduate School of Design, the Kennedy School of Government, and the Regional Plan Association was something called a Regional Resilience Commission. The nomenclature is a little different in some publications, but the general idea is that you have a multi-state agency, which I shouldn't say agency, but a multi-state governmental unit that independently works with third-party asset managers to basically serve as the gatekeepers for the determination of underwriting for projects for regional resilience trust funds that exist at each state level. So this leads us to what is a regional resilience trust fund. The idea is that these are public entities that exist for basically the nomenclature is a little different by state and legislative agenda and legal nomenclature, but these are public benefit corporations that would have an independent portfolio. In this case, the portfolio would be based on surcharges from insurance, property casualty and liability insurance lines issued within each respective state. And we'll get into a little bit of detail here in a minute about the scale and scope of these surcharges. But these surcharges could, with or without bond leverage, be put into a fund and managed as a portfolio. And in each case among the states, they would have some autonomy and certainly control over how they spend that and where that money goes. But the entire, let's say, constitutional agenda, in a way, is to have some regional orientation to the spending of the dollars, which we found, I think, later in the research process, in terms of the necessity to put an awful lot of capital to work and churn the capital in a manner necessary to actually create a true portfolio, would necessitate types of projects that are really regional in their impact and scope. So one of the things we wanted to do was to try to figure out, relating to the Regional Resilience Trust Fund, where do we start? I mean, how much money are we really talking about? I think we can all understand, there's plenty of work going back to the 1980s, particularly as it relates to coastal vulnerability infrastructure. You see work in, let's say, property tax rolls and property and real estate valuations from entities like Zillow, NOAA, NASA. There's a wide variety of research out there, but relating to let's say, resilience and relating to adaptation within the metropolitan region, we started with a sort of base denominator of unmet resilience needs coming out of the unfunded portions of the Community Development Block Grant DR, disaster recovery dollars that were coming out of post-Sandy. So derived from the state action plans for each one of the 3 states, we use this as a kind of proxy. And one of the things I think that came out of this research is that we need several things to understand what our baseline condition is. That is our baseline, let's say, an either impaired asset value relating to infrastructure or an underlying risk exposure relating to a wide variety of systems and assets. What we need in many ways is for states to force a type of transparency on local government to provide this level of data and assessment. Frankly, and this came out this week with Moody's, in the next year or 2, this is going to be imposed on states and local governments in the bond market anyway. So states are, I think, incentivized at this point. This is my own opinion. I think states at this point should try to head off some of that with the bond market and try to create their own accounting and transparencies so that we can really get a full picture of what is at risk over what time period. In this case, we have proxies in the order of 17.9 and $500 million from New Jersey, New York, and Connecticut. Again, these are not necessarily precise or accurate. They serve more or less as proxies for a baseline spending or a baseline demand for money to be spent in the associated categories that you see on the slides. One of the things we wanted to do was to figure out, well, if we're going to have a surcharge, this was originally promulgated as an idea, that is, the surcharge idea was originally promulgated in the SIRR report coming out of New York City. That is the Special Initiative for Recovery and Resilience promulgated by the Bloomberg administration. We wanted to get a sense about, let's say, the rate of surcharge. So how much money would we be able to raise with, let's say, 3 different scenarios: a 0.5% surcharge, a 1%, and a very high surcharge, as we deemed it to be, at 1.5%. To give us a sense about the scale and order of magnitude. What we found is that even in the high case scenarios, we were really not able to raise an awful lot. We could raise billions of dollars, but we would, I think, be limited ultimately in our capacity to put through a, let's say, standard surcharge model. So then we worked backwards and we said, well, if we were going to meet these accommodations, that is, if we were going to meet these unmet needs, what surcharge would we need to charge to get to that amount over the course of a 10-year period? And the reason we chose a 10-year period is because when you look at state insurance surcharges around the country, many of them were sunsetted. This is a political decision. It makes, I think, intuitively, it makes a lot of sense. It's easier to sell this if it's something that sunsets over time. And we wanted to test for ourselves within a 10-year period if we could create an independent entity, that is an independent portfolio with each regional resilience trust fund and the like. So within a 10-year period, we sort of reverse engineered the calculation to figure out what percentage we would have to charge to meet that underlying demand. Well, in Connecticut, it would be about a 1.16% surcharge. Fairly reasonable and fairly modest by many accounts. And again, this is all without the utilization of bond leverage. This is just surcharges being put nominally out to work in the year that they come in. For New York, it'd be a 5.33%. I would say steep, but not a tremendous burden in terms of a surcharge. But for New Jersey, you're looking at nearly a 15% annual surcharge to meet the unmet needs. And if you look here, you'll see that our unmet needs for New Jersey are 11 billion. We took out 5.6 billion from the Community Development Block Grant DR initial calculations because New Jersey had was anticipated through the New Jersey Energy Resilience Bank to take on a certain percentage or a certain functional, in this case 5.6 billion in energy investments through the New York Energy Resilience. So this is an even lower number than we started out with, but the surcharge, implicit surcharge over a 10-year period is pretty steep. The impacts of these numbers on the average annual premium at $1,200 would, range from nearly $200 in New Jersey to as little as $14 in Connecticut. So when you think about this impact in terms of consumers, this is a sense to give you the sort of underlying scale. So we thought about bond leverage and what we could do and multiples of bond leverage. And I probably need to speed up here, and I don't want to take up too much time. When we started getting a little bit of leverage, we realized that we could accommodate some percentage of the unmet needs. And in Connecticut, with very little leverage or with a static amount of leverage, we could far exceed what we call the unmet needs or the sort of resilience deficiency. In New York, we were getting close. In New Jersey, we require a fair amount of bond leverage. The other thing we wanted to do was look at this in terms of if we were to use leverage and think about this as a fund, and as a fund, there would be associated products, primarily debt products, but some percentage, in this case 10% would be grants, the rest would be different types of sub-market loans and a few market rate loans. And what we're really thinking about here, and we can come to this in a second, and I don't want to spend too much time on this, but the idea here is that you're really financing the incremental costs associated with adding some adaptive capacity or resilience functionality to existing projects. The notion that one would have independent projects that are driven in the name of resilience and adaptation is certainly not consistent with global experience in putting these types of funds to work and the types of funds that are necessary. This is really mainstreaming resilience into and adaptation into existing conventional products in a way, or projects, I should say, and really financing the incremental costs. Again, soft loans, concession loans, markets, fixed, a variety of different products. We tried to understand and simulate a variety of terms, a variety of financial return periods, and basically establish a type of stochastic weighting associated with any given range of products that we thought we could put to the market, and based on an overall, again, 90% put into the market in terms of debt products, 10% associated with grants. We use what was called a Sharpe ratio portfolio optimization to understand the various dynamics associated with these rates of these various products to determine and create a type of portfolio distribution. In this case, a certain weighting, and what you see here is years to revolve at 8.15. This is an important number because based on a type of portfolio optimization that is a mix of different types of products serving different types of projects, we found that with a little bit of leverage in the bond market, and assuming that we would spend these dollars and churn it at a certain rate, we could create an independently sustainable portfolio at 8.15 years. Now, this is again, stochastic process, but the number hovering around 8 to 8.5 years was pretty consistent across hundreds of thousands of runs of the model. The implication there is that within a 10-year sunset period, if this was done well and appropriately managed in terms of asset management, that you could get an independently operating fund that would not necessarily need further surcharges at the end of the 10-year period. I would say this is a significant analytical contribution to the idea that one could create an independent, essentially resilience bank that would not necessarily be tied to underlying surcharges or additional revenue in the future. And I could go on. I think in the interest of time, I'll stop. There's a variety of different projects that we highlight on various small grants, different types of concessional loans, different things that we thought about that could be appropriate for the project. Lots of considerations about how you have, because these are public benefit corporations, they often have statutory requirements that they serve the public good. There has been similar utilization for sustainability, but sustainability is very quite clear in terms of the underlying metrics and quantification of public good. Resilience is a little bit different. And there's some measures of abstraction or a lack of, let's say, analytical clarity, often in coming from systems and engineering resilience. And the underlying subjectivity associated with resilience and adaptation itself provides a challenge to the objective notion of public good. There's all kinds of governance implications, and I'll skip over those for now. I think you all can recognize what those may be in terms of underwriting and determination of the allocation of limited resources. At the end of the day, there's actually not as many projects out there as you would think that are scalable, and so the notion of incremental financing for mainstream projects is really, I think, central to the notion of an independent, sustainable portfolio. The surcharges, we understood them again as a little bit of a recap, would be insufficient in isolation. It would require a little bit of leverage in the bond market and the utilization of a fund model, in this case, a Regional Resilience Trust Fund. So, long story short, the Regional Resilience Trust Fund is in fact feasible. It's totally feasible for Connecticut, but maybe not for New Jersey. Because New Jersey is pretty deep in the hole, has a pretty difficult bond market, and I think would be a little bit of a challenge in many ways. So thank you for having me. I certainly welcome any questions you may have. And one thing I would say is that although not entirely public, this model is in the process of being utilized by another state, actually more formally. So hopefully this will have some momentum at some point much sooner than later. But thank you for having me today.
Jesse, thank you so much. I think at this time we can take a couple questions. We want to be considerate of Shannon's time, but does anyone have a question that they can contribute? And most people are on mute, so if you have a question, make sure that you are not on mute. It sounds like we don't have anything queued in the chat bar, so go ahead.
Hey, Sam.
Uh-huh.
It's David Kuttner. Jesse, I'm just curious, if I'm from New Jersey, so if a Regional Resilience Trust Fund wouldn't work in New Jersey, what did you think would, particularly given that New Jersey is the farthest in the hole in terms of addressing its climate change needs?
Yeah, I wouldn't say that it would not work in New Jersey. It just wouldn't be as so clear. It wouldn't be the money would cost a lot more, and there are some advantages and disadvantages in New Jersey. The disadvantage is that the bond market and the long-term trajectory of the bond market in New Jersey is pretty bleak. Therefore, their ability to take the spread within the as a fund and put that to good use would mean that it would likely not be within the 10-year period, that you'd probably have to be more reliant on surcharge revenue, probably going into the 15 to 20-year mark. But the flip side is, or the advantage for New Jersey, is that if you were to extend it, let's say beyond 10 years to closer to 15 years before you got an independent portfolio fund, then you wouldn't be so reliant on the bond market, and that may actually be a positive thing for the state in terms of liabilities on the books. So it's just more difficult. Connecticut is pretty easy. Connecticut could do this without bond leverage. They could independently within 10 years create their own fund with no to little leverage and get an awfully lot done. New Jersey, it would likely extend bill beyond that. So I don't want to totally rule New Jersey out. I just think that it's a more difficult proposition and much more fiscally restrained.
Yeah, the thing that occurs to me is that sort of brings into question whether a regional entity such as the ones that you guys are contemplating, whether it would work for New Jersey, New York, and Connecticut because of the disparities in the way that they're addressing their needs.
Yes, but there's a lot of regional interconnectivity in terms of mass transit, energy transmission, and the like. There's plenty there, I think, to bind the region and put the money to work. At least some percentage of it. Certainly, a good percentage of these projects or these funds would allocate projects that are, home rule, local. But I think there's plenty to go around that is truly regional orientation.
Thanks.
Great. Thanks. I think with that, we should transition to our next speaker. And we have a little more time at the end for more discussion and questions. So I think, Jesse, are you planning to stay with us for the rest of the call?
Unfortunately, I've got to hop off, but thank you very much for having me.
And thank you so much for speaking. I think if people have more questions for Jesse,
feel free to email me.
Yeah, please, and copy me on that, and I can distribute what he responds to everybody else. So,
great.
Our next,
thank you very much.
Thank you, Jesse. Great. So our next speaker, Shannon Cunniff, she's been working on coastal resilience for EDF, Environmental Defense Fund, for 5 or 6 years, and has worked in the field of flood and hazard mitigation for many more years. Shannon is currently one second, let me pull up her bio. The director of coastal resilience, and she will be discussing the environmental impact bond that EDF is developing for coastal restoration and resilience in Louisiana. Shannon, you are up.
All right, Sam, can you confirm that you have the screen share on the right screen at this point?
It is
the big one.
It is not. Select the middle one. I see.
All right, hold on.
There you go.
Oh, is it showing up now?
Can you maybe hit the play from beginning button at the top left? Might help.
Yeah, I don't think that's. Hold on. And I'm not able to pick up the your share screen thing either for the webinar.
You're sharing the screen currently. Maybe go down to the PowerPoint icon, and then if you click on it at the bottom of the screen, I see 3 options, and maybe, try the other. Yeah.
Well, this is the way we did it last time. I can't get it to move. That's the problem.
Yeah, it's not in presentation mode, it looks like.
Well, when I click on it. Let me go out of share mode. Maybe that's part of the problem. Go back in.
Okay. Maybe put it into presentation mode before you actually share the screen.
Yeah, that's what I'm trying to do.
Okay.
Let me try this. Now do you see it?
Yes.
Okay, good.
Awesome.
All right. Sorry about that delay. And thanks for inviting me to talk about our efforts to explore these, opportunities to expand financing options for coastal resilience, which is EDF's perspective on this. So I wanted to start a little bit by giving you some perspective on what we're doing and why we're working in Louisiana. And I promise to go through these first few slides rather rapidly. But EDF focuses on Louisiana in large part because of the wetland loss problem that they are facing and because of the great ecological and economic significance of the region to the nation. So I expect that pretty much everybody that's attending this webinar has at least some familiarity with the situation that Louisiana faces. So, but the kicker fact that we like to throw out there is that the region has already lost about 2,000 square miles of wetlands over the last 80 years, and the situation will get worse, as this slide shows. Oops. So this next slide is basically, this is how that land loss that's occurring translates to flood depths from a 100-year storm event. So God, I'm having trouble moving my slides. So the point being, though, is that the state of Louisiana recognizes the risks that it's increasingly vulnerable to hurricane surge, and it's come up with a very comprehensive coastal master plan. $50 billion plan calls for large-scale restoration over the next 50 years. So anybody who's really observant might notice that retreat and buyout or relocation are not included in the sort of project areas that are described in the master plan. But hold on to that thought, because I'm going to get back to that. So the trick is, with a $50 billion plan, the state only has about $20 billion in funding resources identified, mostly oil and gas related revenues. And for the next 15 years, funds associated with the BP oil spill will be available. Sadly, that gap gets worse when you consider inflation over time, which that red bar on the far right, for those of you who are colorblind, you can see what's happening. So EDF has been working for years to ensure access to funding and to implement the plan, and that the state has the available resources and that they're being used efficiently. So now what we were doing is turning our focus on another question, which is, how do we fill that gap? Are there ways to encourage early investments to reduce the long-term cost of restoration? And are there ways that we might find new sources to help pay for the implementation of the Coastal Master Plan? So back to where I said hold that thought. So the state's master plan is expected to create a little more than 1,000 square miles of coastal land. But even if all the projects were built, the state will still lose about another 2,000 square miles. So there is very much a real need to look at retreat, and that's where there's a new effort that's underway called Louisiana Strategic Adaptations for Future Environment, or LA SAFE, which is a heck of a lot easier to say. So LA SAFE is focusing on engaging communities in the most vulnerable parishes of Louisiana to begin to think about risks and their futures, so that basically to help citizens and communities become masters of their own futures or their own destinies, rather than becoming victims to sea level rise and storms and, adapting in a uncomfortable, rapid, stressed, and chaotic manner. So while that's sort of happening, is a good time for us to begin to start thinking about the funding and financing that will contribute to that kind of thoughtful retreat. So I'm really pleased that you sort of actually got me jump-started in doing some of that thinking. About a year ago, though, we did actually start thinking more broadly about exploring and funding financing issues. And we wanted to first, of course, to identify what were the opportunities we saw out there for increasing the money available to coastal resilience writ large. We conducted an expert survey, a workshop, explored tools, to help fund. Our focus, of course, being more the restoration angle, the wetlands restoration and other habitats too, especially those that act as natural defenses to storm waves, wind, and water, floodwaters. So we found, one of the things we learned is that we found there were several reasons for the lack of private financing for natural infrastructure solutions like wetland restoration. And one was insufficient awareness among the private investors of the multiple benefits from restoring natural infrastructure. A second one was just a lack of awareness of the potential scale of the investment opportunity. And the third would be absence of financial mechanisms that actually could facilitate these kinds of transactions, i.e. funding wetland restoration. So this slide really summarizes some of the various financing tools that came out, and we characterize them in terms of sort of the degree of maturity. So a couple things just real quick to point out here is that green bonds, for example, we put in the middle stage. They are being implemented, so they are actually an established tool, but there's more that can be done to grow that market and to make it more robust in the sense that there's confidence that there is really a green outcome from the investment. That's especially important for impact investors and people who are strategically choosing to invest in green activities. The other thing I want to point out is that mitigation banking we have put in as an established tool, but there is one kind of mitigation bank that is not, and that would be the carbon sequestration concept, a carbon bank. With respect to coastal Louisiana or coastal wetlands writ large, the science still really isn't there to demonstrate the carbon sequestration potential, but it is something that we're monitoring to keep our tabs on. So the areas in the red square are the areas that we were most interested in. And then in particular, because of EDF's sort of angle of being strategic and trying to invest in areas where other people aren't working, we were really interested in the resilience and environmental impact bond concepts. So let me explain what an environmental impact bond is. It's basically it's like a bond, any bond, it can be a municipal bond, and it uses a pay-for-success financing approach that shares program risk with private investors. So the angle is here that the private investors provide upfront capital for the project. Payments from the public sector to the investors are going to be adjusted based on the achievement of a desired environmental outcome. And some project performance risk can be shared or transferred between the payer, the investor, and even potentially the service provider. So the key elements of all of this are having a revenue stream identified. So let's be really clear about this. An EIB does not really create new money out of thin air. The payers are typically public agencies that have the ability to pay back the bond because they have some kind of revenue. So the investors are the upfront capital support, and they're also critical, I'll just leave it at that. And then the service providers are the ones who actually implement the project. So that's the private sector that has expertise in this area. And the critical fourth and fifth elements are the financial intermediary who structures the deal and aligns the stakeholders and figures out the terms. And fifth, an independent evaluator who's pictured in the center there, that assesses whether or not the outcome was achieved. And this is important because it determines then, by saying whether the level of success, the repayment level of the bond will be determined. So we had this concept. We actually received money through the Nature Conservancy's NatureVest Conservation Investment Accelerator grant program to design the first an environmental impact bond for Louisiana wetland restoration. So to obtain this grant, we actually had to develop a financial model that illustrated its feasibility. And that initial analysis we found that an EIB could result in if you were just building a 6,700 acre wetland 10 years earlier than was originally planned, it could save the state around at least $130 million. And I say at least because we tried a number of different transaction costs and rate of return scenarios. So EDF is collaborating with the state's Coastal Protection and Restoration Authority, or CPRA as we call them, or CPRA, and hired Quantified Ventures, the firm that designed the nation's first environmental impact bond for DC water. So our project is essentially exploring whether and how an EIB can help CPRA reduce their construction costs, accelerate the project implementation, share some of the performance risks, and be able to attract potentially new payers. And I'll explain that a little bit more in just the next slide. So this is what it would sort of look like in Louisiana. We would have, starting with number one, Quantified Ventures, and going counterclockwise, because I'm always difficult. So Quantified Ventures, who we've hired, would be the financial intermediary. CPRA has revenue and would be the payer. But we do want to explore other potential payers. And those payers would be folks, or could be folks, that receive benefits from having had the wetland restored sooner, and obviously have to be willing to pay for it. So I'll be straightforward. We may not achieve this with the first environmental impact bond, given the size limitations. CPRA is considering that they would limit the first bond to something in the $30 to $50 million range, basically to test it out and see if it's worth the effort. So that necessarily limits the size or the amount of wetlands that could be restored, and thus the benefits that could be derived. So, but nevertheless, by demonstrating the tool and that there are benefits, like risk reduction, we're laying the foundation for attracting those payers. And the kinds of payers that we're thinking exist in Louisiana could be the oil and gas industry, because they have pipelines that are protected solely by wetlands. The ports themselves are protected by wetlands. Folks that use the Gulf Intercoastal Waterway, for example, that waterway is very vulnerable, surrounded by wetlands. And maybe even possibly levee districts, if we could prove that by lessening wave runout on their levees that they've reduced their O&M costs. So the other players in all this would be the wetland restoration industry firms, folks that are developing or have businesses in mitigation banking would be especially well suited, but it could be other A&E firms. And then of course, the investors. We expect that the investors that would be attracted to this will be those that typically like tax-exempt muni bonds. But if we can't get the interest rates attractive enough, then we do believe that we can still be high enough to attract what are called impact investors. And those are the folks that accept a lower interest rate because their money is resulting in some environmental or social good. And there's actually a growing market for that. So I've talked about or touched upon some of the opportunities, and I've actually even mentioned in passing some of the challenges, like coming up with the right adequate risk return ratio, doing this at the right scale to achieve benefits, and then attract beneficiaries. But other challenges we face and questions that we intend to answer in the process of designing this and evaluating the feasibility of the EIB are things like this. Are there certain types of restoration projects that are more or less suitable for an EIB? What are the performance risks that can and should be transferred to the investor or to the restoration industry? So, what does that look like? What are the right performance metrics to use, to basically be a proxy for ecosystem restoration or risk reduction? And how will factors like sea level rise and subsidence be incorporated and evaluated in terms of establishing those thresholds for performance? And then what other conditions might be needed from an investor perspective? So this is my life for the next several months. As I said, we're designing a prototype. So we're assessing the conditions and the sidebars for what would make a feasible environmental impact bond. So right now we're selecting which restoration area to design the bond around and exploring those outcome-based performance metrics questions. Over the winter, after we've selected that one site, we will actually be doing the heavy lifting of designing the prototype bond and assessing its feasibility. We hope that we can get our assessment complete and provide recommendations to the state by June and finalize and publicize our report in July. So in thinking about the interests of retreat and does retreat fit an EIB model, I pulled together sort of some questions that I think people, as they look at a project or look at things like retreat, would have to consider. So, the first and big one, as I said at the very beginning on the EIB, is that we have to have a reliable cash flow. You have to have revenue. But you don't have to have the revenue in your coffers. That's where a bond helps. It gives you that money, that capital up front. Okay, is there a significant need to be met? The DC bond, environmental impact bond that DC Water environmental impact bond that I mentioned was driven by regulation. The Louisiana one is basically because they recognize they have an existential crisis. There is no regulation that's driving it. Okay, can you articulate that outcome with a performance metric, and can you do it with one that's inexpensive to measure? The point being, if you have expensive metrics, that adds to the transaction cost of the bond, and the effect of that would be to lower the interest rate that's paid, and therefore lowers its attractiveness. And then, is it possible for you to articulate some kind of aspect of risk or a mismatch of risk or a mismatch between the service that's provided and the beneficiaries, something that hasn't been monetized? So, because that's a key part of an EIB, because if you don't have that risk transfer aspect, then you have to ask yourself, why aren't you just doing a standard municipal bond? And I guess this also reminds me that something I didn't say is if you are going to qualify for a tax-exempt muni bond, you actually have to make sure you have the authority, if you're a local institution, that you have the authority to bond for something that isn't bricks and mortar. Some places have that requirement. Okay, like I said before, can you align and find those stakeholders? This is important because it takes work to, design this and work all of the, I'll do this, you do that, I'll share this, and you have to have someone who's going to hang through it. And then, can you attract the investors? Finally, frankly, you're probably not going to know this until you actually try the design and see what kind of interest rates you get. But as I mentioned, there is this growing world of impact and green investors, and I can say this much, that as soon as we made an announcement that we were going to embark on this study, we were approached by some investment firms wanting to be kept informed. So I just take that as there's interest out there. So let me turn real quickly to the other one, which is the resilience bond. So this is, okay, frankly, we haven't started working on a specific project with resilience bond. So full disclosure here, I'm not really adept at understanding the ins and outs and pros and cons of resilience bonds yet. It's something that we're interested in pursuing. So resilience bonds are a fairly new concept. I think the first time it was presented in detail was by Refocus Partners back in 2015. And as I understand it, City of Norfolk, Virginia is now exploring the concept and has hired a financial firm to help them do that. I haven't heard of any of them being implemented. So what the heck is a resilience bond? Well, it's a twist on what's called a catastrophe bond, or CAT bond by its friends. And it's basically, if you look at the green boxes on this slide, it's, which is at the center for those of you who might be chromatically challenged, like my husband. And then you add on the purple boxes, and voila, you have a resilience bond that captures and monetizes risk reduction benefits, because that's really what the whole point of it is. So here's how it works, in theory at least. Imagine City X wants to build a higher seawall or fix a levee or whatever, but doesn't have access to funds. So it goes to a multi-year parametric cat bond for flooding. And the insurer takes the expected impact of that planned investment into account and lowers the premium the city would have to pay. So with that, the cost savings, in other words, in the budget of the city now has the money to fund its seawall or its levee or whatever, even if no disaster occurs. So a cat bond is based on a disaster happening. The add-on here is that if there isn't a disaster, they've just bought down their risk for the investors by doing this additional resilience work and having the money for it. So basically, both a cat bond and a resilience bond are really insurance products and not municipal bonds or corporate bonds that are issued by sponsors. And sponsors are only responsible for paying for the insurance premiums, not for repaying the bond principal. So like I said, it gets complicated. So I guess the point that I really want to leave you with is that what's key to this is an agreement on how much of those savings in insurance can be transferred to a rebate to support restoration projects. And frankly, that means the transaction costs are going to be pretty high for this kind of thing because it's going to be a complex structure, it's large scale, and it's going to require in-depth risk modeling in order to convince folks of what those trade-offs are, both in terms of what's the risk of an event, but also what are the savings. And I would add that resilience bonds would do better, in our world if flood insurance itself was truly risk-based, which isn't quite the case with the National Flood Insurance Program. So again, I tried to put together sort of summary thoughts or questions about, would this work for retreat, and how could it? And this is really just scratching the surface of this. But I think it's something that, you could work through and let's start that process to answer that question. So some are the same, the question about sponsors, you need to have them. But sponsors could be really quite diverse in a resilience bond. So because the sponsors are those parties that have interest in both purchasing insurance and in mobilizing investments to reduce the physical risk from catastrophic events. So based on this definition, any large or public or private asset holder, a city, a utility, universities, hospital systems, et cetera, with insurance needs could be a resilience bond sponsor or co-sponsor. So the other big thing, as I mentioned earlier, is this question of data. So do you have reliable probabilities of future flood and storm disasters? Do you have hard numbers about the impact? In other words, do you know where your assets are and what their values are? Because the data form the basis for any preliminary catastrophe modeling to characterize the baseline exposure and is necessary to assess the proposed resilience project and what it can generate in terms of a measurable and meaningful risk reduction. So there's a pretty high bar there. So the other thing that's sort of attractive about this, and this sort of spans this area between having sponsors and having data, and the analysis can help. By doing the data analysis, you can identify more sponsors, because as soon as you start pulling on that string about, well, where's the asset base and what's the risk exposure and what are the insurance needs, suddenly you can start to figure out all these other spillover effects. If we do this, these people are protected. They have an interest. Their insurance rates are going to go down. So I think that there is this nice positive chicken and egg kind of relationship there. So let me just conclude here that I don't know if either of these tools work well with retreat. I think they could. I think retreat poses some, tricky, interesting questions, in part because retreat is the opposite of bricks and mortar. It's the unbricking and mortaring in many cases. I think perhaps the retreat projects have a better chance of capturing interest from private financing if they're wrapped up and funded as part of a larger plan that, for example, that reflects what would be done with the bought out property. For example, could it be restored to create natural defenses that then help protect people that are further set back? So, I think that both of these tools have promise, and they both deserve exploration at all scales and for different kinds of projects or multi-objective projects. And I'd like to encourage other people to give them a whirl, because we're going to need to do this a number of times in a number of circumstances to really understand all the nuances and the sidebars. So I'm glad you guys got to start thinking about all that.
Shannon, thank you so much. We really grateful for your expertise, and I know we got into, not everyone has a technical background in finance, but the point of this webinar was to really get into some of the new and kind of theoretical applications of financing tools to retreat, and I think your conclusions really drew the link there really nicely, as far as it leaves us with questions about end use. And so I'm conscious of people's time. I think we can leave the line open if people have more questions. I don't know, Shannon, how much time do you have to stick around after this?
I'd be happy to stick around for 10 minutes or so.
Okay, that would be really great. Thank you. I just, at this point, before we lose people who have to leave at 1, I want to say thank you for joining us for this series. I would love your feedback on the series if you were able to attend multiple webinars or this one specifically, and also would love ideas for future webinar topics. So always welcome those via email. And I'd encourage you to go to our website, climategration.org, to see more. We'll have this webinar posted as well as recordings of our other 2 webinars in this series. So please use that as a resource. Does anybody have questions for Shannon?
Hi, Shannon. This is Sasha. I've got a couple of questions. Going back to the restoration bond, or the impact bond. One of the things that you mentioned was the need to have good measures of performance, and in this case, I'm curious, whether you could dive into a little more detail about whether we're, in your particular application, whether it's the performance of the contractors in doing actual restoration in terms of marsh area and et cetera, or whether it is the actual sort of success of that as a resilience set of resilience outcomes for the people on land.
That is exactly what we're talking about right now. So where we're thinking is that the contractor would still have, they would be performance-based contracting that the state would do directly with the service provider. And they might have performance indicators to both drive the design and the construction and even maybe some short period of maintenance for their wetland. But the contractor really isn't going to probably take the risk of things like a big storm coming through, if there's a hurricane. And perhaps is not even going to want to commit to certain outcomes like the long-term viability of the wetland. Is it increasing fisheries resources or duck resources, waterfowl hunting, or even risk reduction. So the kinds of things, so we're thinking about it in sort of 2 scales. One that's pay per performance for the contractor, and then a long-term performance on the wetland restoration, and measuring the wetland restoration in terms of some broad habitat goals, like amount of wetland with foliar cover, water bodies of a small enough size that the sediment is accreting, and possibly also what we really want to do is be able to document things like, yes, it has actually reduced the amount of nuisance flooding that has occurred in the region.
if no one else has a question, I do. Oh, but I see there's a question on the chat link.
Yeah,
It's
David,
from
you can go ahead and read your question.
I can't see it.
Sorry, I was muted. Shannon, have you written anything up that describes what your thought process was, the framework and objectives for the EIBs, and how you expect to implement them that might provide a little bit more insight into, what the expected, what you're expecting from the work, and what you've got, how far you've gotten so far?
Yes and no. On the last slide, and I'll bring it up real quick. I do have a site there. We put some initial information about the study there, and it is our intent to start to hang other information that we generate on that site as we move through it. So I think by mid-January, we will have a white paper that articulates some of our thought process to date in terms of overall design, the performance measures, the site selection. And then there will be a final feasibility report, as I mentioned in July, that documents the full kit and caboodle, so to speak, of what we're doing.
Thanks. That's great.
So I would encourage anybody to, check back every, month or two and see what new material might be on that site. I mean, our intent is to share it broadly so that people can figure out, can they do something similar?
I just have one other question. You said it's $50 billion in projects that are estimated. Have you thought about what the $50 billion would buy if you bought out the properties that are likely to be affected by sea level rise and the changes down in Louisiana?
I have not seen that kind of analysis, but that doesn't mean it hasn't been done. But I would think that it probably has not been a conversation, because when you look at the infrastructure that is in this area, it's oil and gas pipelines all over the place. Because of the key, industrial capacity and oil refining capacity in the region. So it's not going to be simple. I think that kind of analysis will happen more and more at that parish level process, like LA Safe. Well, they're start to look at that and say, well, what is manageable and whatnot. But that being said, the state's coastal master plan did have a very robust economic analysis associated with it that Rand Corporation was involved with. I'm just not familiar with the retreat piece of it.
Good, thanks.
Hey, Shannon, this is Joe Tyrone. We met yesterday via email.
Yes.
And I have a question on the EIBs with the, you have it stated there where it says going to repay investors based on performance. And I'm just trying to understand that, because generally bond investors are passive investors. So they have very little to do with the underlying, what the underlying reasons for the raising of the capital.
Mm-hmm.
So is it structured so that there's like a minimum return and then they share on, a higher return based on thresholds?
Exactly.
Okay, that makes sense.
So, like, for example, DC Waters was, if their project, which was a green infrastructure project, was as successful as the modeling would have indicated, that the investors got a higher rate of return. And the way the DC Water as the sponsor wins, so to speak, is that it proved out the concept both that the green infrastructure could work, and it also meant that they avoided the cost of having to construct a new stormwater tunnel under the city. So they sort of win both ways.
Great. Very interesting. Thank you.
Welcome. And anybody can feel free to contact me by email if you think of something later.
Great. Thanks for that, Shannon. Sasha, do you have any closing thoughts that you'd like to offer?
Not really, except that to say that I think these two speakers today really are showing us the pointy edge of the spear on financial innovation in this space. And my conversations with others in this realm are suggesting that we're seeing increased interest across the private investors, impact investors, and institutional investors in these kinds of vehicles. So I think one issue we might want to either bring our speakers back or follow up with them is sort of what that process and what the lift is to get these things up and running, and how we streamline that. So I'm excited to continue hearing about these new innovations and how it works, and looking forward to meeting all of you in the new year at some point, either in person or here online.
Great. Thank you so much for that. And thanks everyone for tuning in. We will have this recording up on the website soon, as well as the PowerPoints that you've received, and a quick summary of what we learned today. So thanks a lot, and sorry for holding you a little bit longer than usual. Bye. Have a good one.
Thanks, Sam.